course of 2024, the ETFs were the fastest growing ETFs in history. '24 was an absolute great year. So we saw, when we talk crypto, I think it's important to differentiate. You have investment crypto, which is typically Bitcoin and Ethereum. And then you have the second category, which they call alternative coins or meme coins, and it's quite speculative. For today, I'm going to talk mostly about the investment side of crypto. So the investment side, Bitcoin was up over 120% over 2024, largely driven by two things. Early in the year, we saw the approval of the ETFs, and then later in the year, we saw the election of President Trump, who was a very pro-crypto president. So if I go back to the ETFs, in January, we saw the approval of Bitcoin ETFs for the first time. This was a big win for the industry. Over the course of 2024, the ETFs were the fastest growing ETFs in history. We saw the BlackRock ETF reach assets of over $50 billion US dollars. Total ETFs in 11 months was over $100 billion, faster than any ETF category growth ever. The second thing was the election of President Trump. So as part of his campaign, he was very pro-crypto, promising to put in place crypto-friendly regulation. With the election, we saw crypto continue to move up very aggressively, hitting an all-time high in December of 108,000 per Bitcoin. I think we are still very positive about 2025. And there's really four main factors that drive that. So the four factors are a crypto-friendly regulatory structure, the continued investment of funds and institutions, the advance of crypto derivatives, and lastly, mainstream retail. So I'll go into those in a bit of depth. The first one is a crypto-friendly regulatory structure. So we've already seen the appointment of David Sachs as the crypto and AI czar inside of the Trump government. We're seeing replacement or changes in the SEC chairmanship and in another number of the regulatory bodies that will put in place a crypto-friendly regulatory regime for the US market, which is one of the largest markets. That will have influence on a global basis. The second thing we're seeing is funds move into crypto. The size of the funds, the investment funds, the pension funds is massive. And even small allocations of 2 or 3% of those funds' assets on a global scale are massive sums of money. That will also continue to really provide demand for crypto assets. The third one is derivatives. And a lot of people don't understand that derivatives are key for category 2. So when funds make investments, they rarely will make an investment on their own. They will always have a derivative as a hedge. So they don't take naked positions. So the derivatives industry or the derivatives sector also has to evolve quite quickly so that the funds can take hedge positions. And the fourth one is retail. Up until now, there had been largely crypto was driven by retail, or Bitcoin was driven by retail. With the ETFs, we saw more institutions come in. That first stage of retail was the early adopters. Now, like we were talking earlier, mainstream is now talking about crypto. Everybody is now considering crypto. So the bell curve is now starting to move into crypto, and that is also a sizable amount of flows into crypto, both on the investment and on the meme coin side. Sure. So on the challenges, I think you see roughly two to three challenges. One will be on regulatory structures, global regulatory structures. One will be on continued education. Those are the two main ones. So when I talk about fragmented regulatory structures, different parts of the world are evolving their regulatory structures at different rates. Crypto is a global asset. It's a global digital asset. It trades 24/7, 365 days a year. When one country regulates different than another country, then you start to have some inconsistencies. We are seeing most countries that are crypto-friendly start to move forward, but that will continue to be a bit of a challenge going forward. The second one is education. And why I mention education is we at RAIN, we'd like to see people being investors, not speculators. Of course, there's going to be some speculation, but we want people to understand what a digital asset is, the volatility of the digital asset, the risk of the digital asset, and how that digital asset fits into their portfolio. So even though there's been some education in the past, there still needs to be a lot, and people need to understand why they're putting their hard-earned money into a digital asset. The opportunities are massive. So I think I divide opportunities for retail and then institutional. The opportunities are for people to realize, historically, if you looked at investment portfolios, you had cash and cash equivalents, you had debt instruments, which is bonds or properties, and then you had equities. Now we have digital assets, and it's really an opportunity for people to diversify out their portfolios and to be part of the growth of digital assets. And the exciting thing about digital assets is everybody can enter. It's not limited to the private bankers and the private banking clients. It's not limited to institutions. Everybody has access to Bitcoin on an equal playing field. So from that standpoint, cryptocurrency is really a leveler. It levels the playing field and everybody gets access to a great investment opportunity. For the retail investor, it's really do your homework. Don't get caught up, the hype is there. Everybody's talking about crypto right now. Don't get caught up in the hype. Do your homework, understand your portfolio, understand where crypto fits into your portfolio. Understand your risk tolerance. How much up and down can you take? And then look at your time frame and understand your time frame and be ready to hold for a long term. We've seen crypto, we've had a crypto winter, and if you held through the crypto winter, you're handsomely rewarded now. If you got cold feet during crypto winter, you could have booked losses. So I think at the end of the day, investors really need to be honest with themselves. What is my comfort zone? And then how can I invest within that comfort zone? One of the pieces of advice we're giving to retailers is start small, invest on a monthly basis. It's called dollar cost averaging. Dollar cost averaging will allow you to take advantage of the volatility while you get comfortable and while you understand digital assets. Once you understand it a bit deeper and you understand some of the volatility, you can always increase, but start small, invest monthly. It's probably the way to de-risk for most people to get into it. So for institutions, it really boils down to three things. Is dealing in regulated environments, dealing with regulated companies, and understanding the regulatory structure in terms of what percentage of their assets go there. So taking a step back. In regulated environments, it's absolutely key when you're an institution and you've got fiduciary duties and you've got certain obligations to either your shareholders, whether that's public or private. Regulated environments give that sense of comfort and security that the regulator has put in place the controls, the processes, the mechanisms to protect investors and are working to keep that ecosystem safe. And especially with crypto, the ecosystem is changing quite rapidly. Working with regulated companies takes it a step further. Regulated companies obviously have tighter standards, tighter processes, and safeguard investors to a much higher degree than unregulated companies. So for institutions to safeguard funds, knowing you're working with a regulated company in a regulated environment will give a peace of mind, not only to the people making investment decisions, but to the shareholders as well. And lastly, percentage of allocation is, once again, not that different from retail. Understand what percentage of your corporate assets are going towards crypto. Make sure that fits into the overall investment mix. And start small and you can always increase. I think corporations or individuals that start too big and the volatility starts to generate anxiety, it's not worth it. So start small, understand it, get to know the digital asset and especially the volatility cycles, and you can always increase once you understand.